Ladies and gentlemen, good day and welcome to the Q4 FY25 earnings conference call of Gland Pharma Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Runjhun Jain. Thank you, and over to you, ma'am.
Thank you, Saga. Good evening, everyone. We welcome you to the Gland Pharma's earnings conference call for Q4 FY25. Today, we have Mr. Srinivas, Executive Chairperson, Mr. Shyamkant Giri, Chief Executive Officer, Mr. Ravi Mitra, Chief Financial Officer from India's office, and Mr. Alan, CEO of Cenexi, who is connected virtually from France. We will begin the call with business highlights from Mr. Sadhu, followed by operational highlights by Mr. Giri. This will be taken up by after Cenexi for the updates about Cenexi from Mr. Alan, and lastly, the group financial overview by Mr. Ravi. Before we proceed, I would like to remind everyone that some of the statements made today will be forward-looking and are based on management's current estimates. These statements should be considered in light of the risks associated with our business. The call is being recorded and the playback and script will be available on our website shortly. With that, I hand over the call to Mr. Sadhu for his opening remarks. Over to you.
Thank you, Ranjan. Good evening, everyone. Thank you for joining us today. On behalf of Gland Pharma, I welcome you to our fourth quarter and full fiscal year 2025 earnings call. Let me begin by providing a strategic overview of the business, reflecting on the past year and outlining our vision for the company's future. Following this, Shyamkant will discuss our operation performance, Alan will provide updates on Cenexi, and Ravi will conclude with the financial review. Reflecting on the year gone by, FY25 was a pivotal year. While we faced near-term growth challenges at both Gland and Cenexi, I want to assure you that we use this time wisely to strengthen our foundation and sharpen our long-term focus. The global landscape has presented renewed complexities this year, especially with the announcement of reciprocal tariffs by the US administration. This has created a layer of uncertainty, particularly for Indian pharmaceutical companies, which have a significant presence in the US markets. Despite these headwinds, we have maintained our flexibility across demand and supply fronts. Gland's value creation journey remains anchored in the strategic execution of our operational model, and we foresee a promising growth trajectory ahead. Let me now take you through the key pillars driving our growth strategy. Starting with the base business expansion, we are expanding geographically with a strong push into emerging markets across Africa, the Middle East, Latin America, Asia Pacific, and the rest of the world region. There is a substantial market opportunity in our approved US ANDA portfolio and market formation opportunity by an upcoming pipeline of injectables post-patent expiry. In addition to recent successful new product launches, we are leveraging our long-standing relationships with key partners to deepen our global reach. Next, we have made significant progress in expanding our manufacturing capabilities with new lines, including complex injectables and new delivery systems like pens and cartridges. A key milestone was our successful entry into the GLP-1 segment with the launch of liraglutide, given that we see GLPs as a crucial area for Gland's future. With 2 GLP-1 contracts secured and a strong market demand anticipated, we are scaling our cartridge capacity from the current 40 million units to an additional 100 million by CY 2026. We have broadened our capabilities to include suspensions, hormonal products, microsphere bulk, microsphere powder filling, while strategically focusing on ready-to-use products like dual and triple chamber bags. Importantly, we are also experiencing significant momentum in attracting major pharmaceutical companies interested in partnering with us for high-value formats like dry powders and have already successfully initiated several new CMO projects. Moving to our R&D and portfolio expansion efforts, our strategy spans 3 focus areas: in-house R&D, complex products, and a co-development model. Our in-house R&D covers a wide range of therapeutic areas, supported by 371 filled and approved ANDAs and 1748 global registrations. Our future pipeline now targets major therapies like ophthalmology, CNS, cardiology, with near-term generic opportunities covering a 1.25 billion market, which is about 40 new NDAs, a 1 to 3 year pipeline targeting 2.12 billion, and a longer-term pipeline in a 2.34 billion market. In total, our in-house pipeline includes 71 new NDAs with a 5.7 billion TAM. In FY25, we launched 31 new products in the US, and we expect this momentum to continue. Additionally, we filed 3 RTU infusion-backed products with 10 more in development as part of our 14 registered RTU-backed products targeting a $530 million US market. We are also focusing on additional complex injectables and have 19 products in this bucket, with 6 already launched and 3 more anticipated for approval, addressing an IQVIA market opportunity of approximately $6.5 billion. To accelerate our pipeline and portfolio expansion, we are pursuing co-development, wherein we are partnering with a specialty injectable development company for 15 products, out of which 6 are 505(b)(2) and 9 ANDA submissions, which are focusing on key therapeutic areas like immunology, chemoadjuvants, mineral supplements, pain management, endocrinology, and radiocontrast agents. Gland is also building a robust CDMO setup for biologics, leveraging our existing biologics manufacturing capabilities. The biosimilars market is a significant driver in this effort. A key step in our strategic expansion into biologics is our collaboration with Dr. Reddy's Laboratories, which marks a significant step in this direction, with revenue contribution expected in FY26. Furthermore, we have progressed on a non-binding agreement for CDMO collaboration with Shanghai Henlius Biotech, positioning us as a secondary manufacturing site for some of their key biosimilar products. To support this and future growth in biologics, we are expanding our bioreactor capacity by 15,000 liters. These collaborations reaffirm our strategic focus and investment in the growing biologics CDMO area. Turning to Cenexi, while we encountered challenges with below expectation performance, however, we have made progress in defining its turnaround strategy. We recognize that the acquisition thesis has taken longer than expected to fructify, but our strategy to achieve robust growth and profitability remains centered on high-value products. This necessitates a deliberate shift from our previous business model of low-value, high-volume business, which constituted 70% of our current operations, towards higher-value products such as prefilled syringes, lyophilized vials, and ophthalmic gels. This evolution is expected to expand our net realizable value per unit and improve overall profitability. Cenexi's dedicated business development efforts are yielding results with the successful addition of new customers for prefilled syringes, vaccines, and lyophilized vials, aligning with this high-value focus. To facilitate these transformations, we are strategically investing in capacity enhancements and building business scale through increased automation. Finally, in parallel with our organic initiatives, we are actively exploring inorganic opportunities via mergers and acquisition to accelerate complex product development, gain access to new technologies, expand our product range, and enter new markets. In summary, while FY25 brought challenges, it also reaffirmed our strategic clarity. We believe the steps taken by us across our key pillars will drive a positive impact on Gland Pharma's success and long-term sustainability. Thank you for your continued confidence in Gland. With this, I will now pass the call to our CEO, Mr. Shyamakant Giri, to share his thoughts for Gland's road ahead. Thank you.
Thank you, Mr. Sadhu. Good evening, everyone. Following my initial months at Gland, I have focused on understanding the business in depth and aligning our capabilities with the strategic levers that will drive our market position and generate value. Broadly, my priority has been to identify key areas of profitability enhancement and new avenues of growth. Before I outline the initiatives underway to strengthen our competitive position, let's discuss our quarter and full year performance. In Q4 FY25, our consolidated revenue stood at INR 14,249 million, with a consolidated EBITDA of rupees 3,475 million, reflecting a 24% margin, a 100 basis point increase year over year. Excluding Cenexi, our base business reported revenues of INR 10,332 million in Q4 FY25, a 12% year-over-year decline, primarily due to the higher milestone realization in Q4 last year as compared to this year in the US and few major tender misses in ROW markets. This impact was partially mitigated by new product launches, and we anticipate sequential improvement as our pipeline commercializes. Encouragingly, the base business EBITDA margin expanded to 38% from 36% in the prior year, driven by favorable product mix and benefits of cost optimization. For the full year 25, our consolidated revenue reaches INR 56,165 million, with an EBITDA of 12,689 million, resulting in 23% margin. Excluding Cenexi, base business revenues were INR 41,248 million, with an EBITDA of INR 14,451 million, translating to a 35% margin. Our volumes for full year 25 grew overall by 4%, including new launches, aided by 9% volume growth in the US, again including new launches. Our new product launches in the US are yielding results, thereby quarter 4 full year 25 grew 10% sequentially over quarter 3 full year 25. On a full year basis, our new launches now contribute 6% to the total revenue. In the US market, we launched 4 new molecules during quarter 4, including latanoprost, midazolam, RTU-BAG, dexamethasone, and new strains of vancomycin. Other regulated markets, primarily Europe, Canada, Australia, and New Zealand, grew by 4% and now constitute 23% of total revenues. The ROW market contributed 17% in quarter 4 25, amounting to INR 2,404 million, a 14% decrease due to tender misses and softer order intake in key regions. The Indian market generated 525 million rupees, representing 4% of our quarter 4 FY25 revenue. Our quarter 4 FY25 R&D expenditure was rupees 503 million, or 4.9% of the base business revenue. For the full year, our R&D investment totaled rupees 1,922 million, that is 4.7% of base business revenue. On the compliance front, we received EIRs from the US FDA for our Dundigal and Pashamylaram facilities, confirming successful closure of recent inspection and reinforcing our commitment to stringent quality standards. It's been a challenging year for Cenexi. While foundational groundwork for a turnaround is in place, results have fallen short of expectation. Our quarter 4 FY25 revenue was euro 43 million, affected by lower production at the Fontenay facility. Encouragingly, our gross margin improved to 79% from 77% in the prior quarter. Alan will provide a detailed update, but we want to assure you of our intense focus on Cenexi and the implementation of necessary changes to improve its financial performance and achieve our strategic objectives. Finally, a brief update on the key priorities outlined last quarter. We have been fortifying our capabilities and global expansion potential. We are currently refining our strategic direction and growth blueprint to position Gland for sustained success. On the demand side, our priorities include enhancing our footprint and launching new products in high-value, high-growth ROW markets, leveraging our strength in specific therapeutic areas, and exploring inorganic opportunities to achieve significant growth in the India market. In the US, the primary focus remains on acquiring new customers and increasing our share of business with existing partners, supported by an accelerated portfolio strategy focused on co-development, in-licensing, and partnerships in high-value injectables and newer modalities. On the supply side, our priorities are centered towards maintaining quality and cost leadership. We are continuously improving our operational efficiency to preserve our competitiveness and industry-leading quality and compliance records. Strengthening our leadership team with critical hires and building capabilities across functions. With innovation, collaboration, and excellence as our guiding principle, I am encouraged by our progress and optimistic about Gland's trajectory. Your continued engagement and insights are invaluable as we move towards as we move forward together to build value. With this, I would like to hand over to Alain for a more detailed update on Cenexi's performance. So over to you, Alain.
Thank you, Mr. Giri, and good evening to everyone. As Mr. Sadhu and Mr. Giri outlined, Cenexi's performance showed marginal improvements over previous quarter, and we will continue to make calibrated progress towards achieving sustainable scale, with a dual aim of securing profitability and resolving the execution challenges seen in recent quarters. To provide a more granular perspective, let me walk you through key updates at the site level. Production at our Fontenay facility in Q4 was impacted by ongoing remediation activities following the ANSM inspection in Q3 financial year 2025, as well as the breakdown of 2 equipment that affected our performance in the first 2 months of the quarter. These disruptions led to reduced shipments and consequently lower sales figures. On a more positive note, I am pleased to report that our new high-capacity ampoule line has started production as planned at the end of January and now enables us to better serve the needs of our customers. While operations at Hérouville remain below break-even due to suboptimal utilization, we have several ongoing tech transfer projects in development that are expected to contribute to this site's growth. We are encouraged by the ramp-up in the commercial production of a new ophthalmic gel, and validation batches for the inactivated vaccine project are progressing as per schedule. Furthermore, we have initiated the installation of a new pre-filled syringe line, which is projected to be operational beginning of calendar year 2026. This will substantially increase our capacity in the high-demand PFS segment and is expected to drive significant revenue per unit and overall value. I am pleased to share that the Braine-l'Alleud facility has met its target for this quarter. Our 2 new lyophilizers arrived on site and are being installed. Qualification for this new lyo capacity will be finalized at the end of the calendar year 2025. Additional vial and lyo capacities are also planned to be added in our Belgian site in the next 2 years. The long-term prospects for this business remain robust, with high-value projects in our tech transfer pipeline. Finally, our Osny site continues to deliver a strong performance thanks to a premium strategic positioning on hormones and anti-allergenic products market segments and strong operational execution. In light of the challenges faced, last year's overall performance remained below expectations, and we believe financial year 2026 will mark the beginning of a meaningful turnaround. We remain firmly focused on achieving our midterm objective of delivering positive EBITDA by Q3 financial year 2026. Thank you for your time. I will now turn the call over to Ravi to discuss our financial performance. Ravi, over to you.
Thank you, Alain, and welcome everyone joining us today. We thank you for attending this call as we review our financial performance for the fourth quarter and the full fiscal year 2025. The FY25 revenues remain flat at rupees 56,165 million. However, a key positive was the marginal improvement in gross profit margins. Consolidated revenue for Q4 FY25 declined as compared to previous year, while it improved from the trailing quarter of this year. This is driven by the reasons as mentioned by Giri in his commentary. In Q4 FY25, our consolidated EBITDA margin improved to 24% from 23% in the corresponding period of FY24, led by base business and improvement in Cenexi's profitability. Our base business, excluding Cenexi, exhibited increase in EBITDA margin for Q4 FY25, reaching 38% compared to 37% in the same period last year. This improvement was primarily driven by enhanced gross margins and more efficient cost management practices. At Cenexi, the losses reduced due to improvement in performance in this quarter. Our EBITDA for the full year ending March 25 amounted to rupees 12,689 million compared to INR 13,331 million in the previous fiscal year. The reported EBITDA margin for FY25 stood at 23% on a consolidated basis and 35% for our base business operations. While the base business margin improved due to better contribution and control in costs, Cenexi's lower performance in some quarters in this full year impacted the consolidated EBITDA margin by 1 percentage point. Gross margin for Q4 FY25 also reflected positive momentum, increasing to 66% from 61% in Q4 FY24, primarily due to higher contribution achieved in new launches and better raw material cost in few of our key products. Within our base business, the gross margin in Q4 FY25 was at 61% compared to 56% in the previous year. On a full year basis as well, the gross margin have improved by 100 basis points as compared to previous year. Our net profit for the fourth quarter increased by 3% to INR 1865 million compared to Q4 FY24 and declined by 10% in the full year as compared to previous year. During the quarter, we achieved a PAT margin of 13%, consistent with the previous year. For the full fiscal year, our PAT was rupees 6,985 million, resulting in a margin of 12%. Other income, which is mainly interest earned from bank deposits and foreign exchange gain, amounted to rupees 440 million in Q4 FY25, is lower than as compared to rupees 585 million of Q3 FY25, primarily due to reversal of foreign exchange gain during the quarter. For FY25, other income was rupees 2,136 million, which has increased as compared to rupees 1,702 million in previous year due to increase in interest income. Higher finance cost incurred during the year is related to interest charges on a GST refund matter. Total R&D expenses for the fourth quarter were rupees 503 million compared to rupees 437 million for the same period of the previous fiscal year, representing 4.9% of revenue from operations on an ex-NXT basis. For the full fiscal year, total R&D expenditure was rupees 1,922 million, which constituted 4.7% of our revenue and increased from last year's 4.3%, underscoring our ongoing commitment to R&D. On a standalone basis, our effective tax rate was 26% in the fourth quarter and same 26% for the full fiscal year. As of March 31st, 2025 at the group level, our total cash and cash equivalents stood at rupees 25,562 million. After accounting for Cenexi's debt, our net cash position was rupees 22,870 million. Cash flow from operations during FY25 was rupees 9,147 million. Working capital as of March 31st, 2025 was rupees 21,683 million. Our average cash conversion cycle improved to 172 days for the 12 months ending March 25, compared to 173 days in the corresponding period of the previous fiscal year. Total capex during the quarter amounted to rupees 886 million and full year FY25 amounted at rupees 3,938 million, allocated to Gland's Indian sites and Cenexi. In India, our growth capex is focused on expanding a new bag line and increasing packing capacity. We are also in the process of adding a new cartridge line at Tweet 9, which will complement the existing cartridge line at our Bachmanaram site. As Ala mentioned, at Cenexi, we are investing in additional high-speed and new lines and lyos to enhance overall capabilities. With that, I would now like to request the moderator to open the lines for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star, then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you wish to register for a question, please press star, then 1. Our first question comes from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. My first question, just a clarification. What would be the profit share milestone number for the quarter? I seem to have missed that. Hello?
You want the absolute number?
Yes, the profit share and the milestone number, please.
So it's about 145 crores. It's about 14% profit share.
Okay.
Milestone is
Okay.
6%. Milestone is 6%.
Okay, got it. If I look at the US business adjusted for these two, then it seems like, we've been in that, 70 to 70, $5 million range per quarter in the US business, despite the fact that we've launched, 31 new products in the year. How should I think about growth from the US business as we launch more products or gain more volume, in terms of growth? What should this run rate be next year and the year after? And just an add-on question to the US market, given the noise around tariffs, what are we hearing from our customers in terms of the ability to absorb or pass on that? Thank you.
Yeah, from the US revenue perspective, while there's from the new launches about 4% growth, which came from US. But there also normally over the years it's been around 8 to 10% growth, which used to come from new launches. What happened was the products, there are several key products where the material costs have gone down and the end market price also was reduced, the transfer price. So the revenue came down, but the margin was intact. That's one of the reasons why actually the revenue didn't move that much compared to previous years. On the tariff side, it's too early to comment, but what we hear is for generics, it will not impact that much. And for us also, what we see is probably most of it will be passed on if there are any tariffs which is levied on Indian imports.
And, so, from the US business, I was thinking about, from the, 70 to 75 million that we're doing, extra milestone and profit share. What should this number be over the next 2, years? What will the new launches now will be able to reset this base higher, or, what should drive this base higher?
Yeah, it should contribute more, looking at the historical numbers and also the type of products which are going to get approval in next year or two, more from the complex side. And also we are looking at, as a business, we're looking at mid-teens as a growth for the coming year.
This is for the US business or for the consolidated business?
For the consolidated.
Okay, got it. And on the ROW business side, it seems like the Saudi contract tender has been, delayed for some time. So what should drive the growth of the ROW business, for us, given that the Saudi contract is not coming? Are there any more drivers for us, or this is the new base that we should be operating, that, Gland should be operating at?
Hi, Neha. So, yes, you're right. But, what has also happened is the Saudi NUPCO, of course, we lost. There's a tech transfer going on right now where we are engaged a local partner to manufacture enoxaparin. The volumes will come back. But what we are doing also is in a place defining a non-enoxa, non-heparin strategy. Okay, so we have clearly earmarked some high growth countries where we have a very portfolio approach, a targeted registration approach, which will help us going forward. We have approximately upwards of around, 500 registrations still pending, which will come over years, And so there are 3 growth levers here. One is how do we push the current registration? Okay, how do we use our cost efficiency that we have to win tenders in some of the key tender market, and how do we again be a very focused in-country kind of strategy. So we define and play in the country with a very strong portfolio approach. This quarter also what has happened was because of the US volume, we dedicated some capacities to ROW, but we are back on track, So that's what we do this quarter. But our long-term vision on ROW is the strongest. We internally have reasons to believe that this business can double over the next 3 to 5 years.
Got it. Thank you so much.
Thank you. A reminder to all the participants, if you wish to register for a question, please press star, then 1 on your touchtone phone. Our next question comes from the line of Bino Pathiparampil from Elara Capital. Please go ahead.
Hi, good evening. Just a follow-up. Did I hear right that you said next year you are looking at a mid-teen growth at the overall level?
That's correct.
Okay. That is including Cenexi? The consolidated revenue? Okay.
That's correct, yes.
Okay, got it. And apart from the improvement in Cenexi margins, are you looking at improvement in margins in the rest of the business as well?
So rest of the business, actually, it's been pretty good. I mean, stabilized around 37-38% if you have seen last 2 quarters. So we continue to maintain around that margin profile.
Got it. And from your presentation, I can see that you have 27 Para 4 filings in the U.S., out of which how many would be of any first-to-file exclusivity?
Give me a second. We can come back to you on that, to give you a precise data.
Sure. More, I'm looking at any big exclusivity launch expected in the next couple of years, 26 or 27, for financial years.
Yeah, we'll come back to you on that, yeah.
Okay.
First of all.
Thank you.
Thank you. Our next question comes from the line of Ashish from Everflow Partners. Please go ahead.
Good evening to the management. So my first question was, what sort of growth could the GLP drug be for us in the coming years and over the next 2-3 years? Would they meaningfully accelerate our growth trajectory?
So GLP, right now, our position is around 40 million cartridges. Next year, we will be one of the top-tier cartridge capacity company with 140 million. Now, GLP, as you know, in many markets is going off patent. So this is really a fill and finish opportunity that we are looking at. And our initial success is giving us all the strength to go further and block all the capacities in the coming time. How will the market behave on the demand side, on the patient pricing side is something that partners would answer. But there is only encouragement. There's only good news around GLP. The kind of volumes the partners are discussing are very, very high. So we feel that this market will explode by volumes at least in coming years.
Right. Could you please quantify the growth in the next 2-3 years given the product pipeline and base business?
Ask again.
Could you please quantify the growth? Yes, sir. Could you please quantify the growth over the next 2-3 years for our business given the product pipeline and base business?
So we next year we said about mid-teens. Subsequent few years, 2 years, it will be low 20s.
Okay, got it. Yes, sir. Thank you. That's all from my side.
Thank you. Participants, you may press star, then 1 to ask a question. Our next question comes from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hello, am I audible?
Yeah, go ahead.
Yeah. Thank you so much for the opportunity. So just wanted to quickly understand the thought process on Cenexi. So what I can understand is Cenexi is largely a generic CDMO business. But I am not understanding that why is the employee benefit expenses 60-65% of my revenue? And have we over-invested in people where now that we scale up from here, the margins will flow directly to the bottom line? So that is question one from my side.
Yeah. So, the average cost of manpower in Europe is around 40. So, yeah, so comparatively, it's a bit more manpower is higher at Cenexi. I think that's the issue where we need to address. But it's also related to how much revenue we are getting and how efficiently we can manufacture there. So with the investments we're making on the capex, so we are installing more efficient lines. That will give us a large throughput. At least, two sides have demand which is more than what we're able to supply today. With the new lines which are adding up, that should cover the revenue loss what we're having today. From the strategy perspective, if you see, these are branded generics is one, the solid business. If you look at the customer base and the volume base what we have, it's been very consistent over many years. That's the nature of the business. Second, also technology is what Gland do not have. They do have. They do make syringes of oncology products. They also have hormonal products. They do vaccines and some biologics products as well. So from technology perspective, they have additional things. That's the logic behind accepting it. And of course, de-risking ourselves on our business in US, which was most of the business was in US, and to enter Europe, we need to have this kind of a business. So there are several reasons on why we acquired it. But yeah, from efficiency perspective, that's where we are focusing currently because, like you rightly said, the manpower cost as a percentage to revenue is quite high compared to the other companies in Europe.
And so a couple of questions, both are interlinked with each other. In your presentation, you said that we are planning to spend close to 60-odd million euros over the next 3 years in Cenexi. So one is that when will we achieve a double-digit EBITDA margin in this business, that is Cenexi? And what will be the ROC of this business? Because if we are investing 60 million euros over the next 3 years, and the base business can do a 25-26% ROC comfortably, and if we are not able to achieve that, then doesn't it not make sense to judiciously use the cash flows in investing for a Gland-based business? So that is the thought process that I want to understand from the management.
Yeah, so basically this capex is an investment for the long term, and we are increasing the capability and capacity. We have sufficient visibility of the pipeline and the business interest. There's a strong funnel we have with the customers. So we will be spending this money next 2 to 3 years in building, like Alan mentioned, and we spoke about it. Is one is of course adding a new refill syringe line in HSC, which will entail a much better realization per unit sale than what currently we do. And then in the Belgium side, we are adding one additional wire line and lyos that will significantly improve the capacity of high value business, and there is already tied up business and contracts for that. So we are looking at break even in this December quarter, and then next year we should improve the EBITDA margin significantly. There's a high operating leverage there, and we should be getting reaching the almost the earlier double-digit EBITDA in the next year after that.
Understood. So just one last question from my side. So to the earlier participant, you mentioned that we are aiming to grow at mid-teen growth for the entire business. So how should one look at from overheads perspective? So do we see the overheads that is what the Cenexi and the base business increasing with lockstep with the revenue growth, or there is some room for operating leverage now?
No, there is ample room for operating leverage. Like you're mentioning that the overhead typically in injectable capacity is about 80% or more fixed. and the workforce which they have currently is sufficient to take care of the additional line we are adding. We are not going to hire new people for that. So, and it's inside the same facility, so the electricity and other overhead will remain the same. So as and when the revenue ramps up, we would see the margin expanding.
Understood. Thank you so much, and wishing the team all the very best.
Thank you. The next question comes from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, out of that 3 anticipated approval from the in-house complex pipeline, could you just share, the market size and let's say the competition that can come up at the time of launch by Gland, without naming the product, maybe? Hello?
Yeah. So from a pipeline perspective, we have total 71 ANDAs in the pipeline with a TAM of around 5.71 million, of which our genericized portfolio has around 40 ANDAs, covers a TAM of around 1.24. In next 1 to 3 years, our pipeline we have 5 NDAs with a TAM of around $2.12 billion. And beyond 3 years, our investment that we are doing with co-development partners, the 505(b)(2), the NDA, we are targeting a TAM of around 2.34 billion market. Okay, so if you see from an revenue standpoint, we see also 33 launches in the US. Our new launch give us more gross margin than the average gross margin. For example, we have 72% as gross margin only from the new launches as compared to the company average of 58%. And therefore, we are very focused on what to launch going forward. And yes, we are a manufacturer. So from a demand estimate standpoint, we do get forecasts and all from the partner company. So we are looking forward for, again, a similar kind of revenue contribution from new launches in the coming year.
Sure, sir. How much would be the contribution from Enoxa and Heparin for fourth quarter and FY25 across the geographies?
Give a second.
Yes, sir.
About 15%? 14%, yeah.
14% for the quarter as well as FY25?
14% of the total revenue.
Yeah, for the quarter as well as FY25?
FY25 is about 14%. And
okay.
The quarter is about 16%.
Sir, secondly, this milestone as well as profit share, if you see last couple of quarters, this quantum has increased on absolute basis as well. While it was difficult to predict per se, but how to think about this maybe for next few months? Are there any good products which can still sustain such kind of income for us?
The milestone actually last quarter is lower than before because it's it will not be consistent on a quarter on quarter. It depends on what milestone we hit in that particular quarter. Some are signing milestones and some are when you hit filing or if it's a tech transfer, then if you close exhibit batches. So the timing will be different, but overall annual basis, if you see, it's more consistent. So I would say milestone you have to look at on a yearly basis. The profit share, it depends on how many launches we have done and how it has increased. If you see the launches, what we've done in Q3 were more, almost I think 13 products we launched in Q3. So that will contribute higher profit, and that's the reason why we got a higher profit share in Q4.
Got it. So GLPs are also contributing for this milestone income profit share?
No. It's nothing to do with GLP. I did not into that.
Understood. And just lastly on this biologics front, while, one contract is expected to sort of start revenue in FY26, but broadly, if you could share, like, how much, overall we can expect in FY26? Is it like $25-30 million to start with in biologics business, or it will be still a gradual scale up in this segment?
Yeah, for FY26, it will be about 100 crores, I would say. Then it will gradually increase.
Understood, sir. Thank you. That's it from us.
Thank you. Our next question comes from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, good evening. Thank you for taking my question. Sir, when I look at the overall US revenue, annually around 3,000 crore, 350 million, and I'm just trying to tie it up with the growth guidance. So we need to, I think US needs to go at least 15% given the size. So we're looking at an additional $50 million of revenue. So just want to understand how is fiscal 26 different from 25? I thought we had a similar ambition to grow. So, and clearly the launch track record has been very strong. So is that what is going to be driving this 15, 16, 17% growth in the US, which we have not seen so far, but maybe it comes in 26. So what gives us that comfort on guidance?
So FY26, overall we are seeing 15% growth. It's a combination of some growth coming from Cenexi because, the numbers will improve that. You're already seeing that in last 2 quarters. So some growth will come from there. Some growth will come from the new launches. And some is the tech transfer projects what we started. Some dry powder contracts what we have done that contributes about 60-70 crores. Yeah, about 60-70 crores from that. Then the biologics will contribute around 100 crores. So there are different levers which are contributing this combination of. Also, if you see our volume growth in US is substantial, while the prices have come down because of the overall material costs. So the top line has kind of, from the transfer price wise, it's stabilized. Now the volumes have gone up. Even if you look at our top 10 products, that has actually grown around 24% in terms of volumes. So there's a lot of uptake in terms of our top products, especially even if you consider heparin, inoxa, not just these two, but there are several products where we got some newer contracts. So added to that, what's happening is what we have invested into the line time and also some of the R&D investment which has gone into life cycle management of products. That has helped to reduce our costs and that made us more competitive, and that's the reason why our volumes have increased and also while the prices have come down, still we're able to maintain that EBITDA margin. So that kind of consumes some of our line time, which has actually mitigated some of our business growth in ROW. So that will also now come back because we have new 3 lines added this year. So that will be coming on track. Yeah.
Helpful, sir. So despite all this volume growth, I think pricing or whatever transfer pricing related pressure has been high. How would you quantify that for, say, fiscal 25, and what gives us the confidence that pricing will not even worsen in 26?
When I say the financial, the end pricing has not changed, what we said is the transfer price have gone down because we have reduced our material costs and changed our suppliers to be more competitive in the market. So we get more contracts. That's why the volumes have increased. At the same time, we're able to maintain margins.
Understood, sir. Thank you and all the best. Thank you.
Thank you. The next question comes from the line of Viresh Pathak from White Oak. Please go ahead.
Yeah, thank you. Sir, how much have you spent on that 100 million pen line?
100 pen line. So, this cartridge line is due to be installed this year. The overall cost would be about 120 crores. Everything together. Only for this cartridge.
120 crores. Okay. Does Cenexi also have cartridge lines?
No, only syringe lines, no cartridge. But the syringe line can also handle cartridges, but restricted to sterile cartridges. They can't do bulk cartridges.
Restricted to?
The top line can be used. The syringe top line can be used to fill sterile cartridges.
Okay.
Not the bulk. Yeah.
Okay. Sir, just on Cenexi, so we paid 230 million euros. Then we are spending another 60 to enhance the capacity. Then another 30-40 in loss funding. We end up spending 350 million euros. Even if we do, 200 million revenue, double-digit EBITDA, barely making, and then if you add on that tax and maintenance capex, this looks like even if we get to that milestone of, double digit, how much we have spent and the bandwidth and all that it has taken seems like a very poor capital allocation. So is this a business even worth pursuing based on whatever, obviously, benefit of hindsight and whatever your understanding is currently? Is it a business worth pursuing?
So the Cenexi, the investment thesis is taking longer than what we estimated, for sure. But now that we are back on track, so with this additional capacity which we are adding to this capex, this will take our revenue to not 200 but 300 million in 3 years' time. And then we are looking at EBITDA of about high teen as a percentage.
Mm-hmm.
So and there is also strategic lever which we have not yet been able to get the benefit out of it. Simply because we are currently focusing on getting the things house in order. For example, we are looking at cross-selling to each other's customers. We have not looked at that aggressively yet.
Yeah, if you look at the customer base of Cenexi, they have big CDMO players whom actually we don't have access to. Also, these players also sell in rest of the world markets, and they are looking at increasing that market, getting products out of India. So a lot of other benefits we looked at when we invested into this asset. But currently the focus is on making it a bit more efficient to get that on track and then work on the synergies, because there are too many things you can't do at the same time. So from long-term perspective, that was the thesis, and still there. There are several opportunities where we can use this. Like I said, the controlled substances, we can't make it from India and sell in US. There are very few players who supply those products, but Europe can supply. So they also manufacture a few products to other players who supply to US market. And, we actually are restricted in that. So the idea was we can actually develop some products in India and then transfer there and supply to the US in terms of controlled substances. So there are several other areas of synergies what we looked at when we acquired this asset.
Mm-hmm. Limited point, sir, is that even at 300 at high teens, it will not be like the best of, return on capital investment. So it just looks like that doing this kind of a CDMO work in Europe is, assuming that when we get to high teens, we would be among, in terms of operating efficiencies, in terms of top quartile in the European assets. With this kind of an asset price, at least doing this kind of a business in Europe does not look as attractive. Unless you're saying that, we can scale up even much higher than this. So that's my limited point. I'll leave it at that. But thank you so much for clarifying.
Thank you. Our next question comes from the line of Harsh Bhatia from Bandhan Mutual Funds. Please go ahead.
Yeah, thank you. Am I audible?
Yes, sir. Please go ahead.
Sure. Thank you. So two quick questions. One is in sort of relation to a comment you made earlier. So in terms of the capacity expansion, again, related to the Cenexi part, so multiple line items and expansions, including ampules and lyophilization. Is there a situation right now where we are not able to take incremental business because of high level of capacity utilization or some other reason, which is why we are going so aggressively for this capacity expansion plan? I mean, I'm just trying to sort of piece together. So.
Yeah, at least, two sides, I think we are not able to cater to the demand because of, I would say, slower lines or inefficient lines, I would call. So one is, of course, replacing the current lines in one of the sites. The other is adding new capacities because of the demand for Lyo products. One is for the current products what they are commercialized and also the pipeline what we have. And moving forward, Lyo, as you know, contributes more in terms of margin. So we need to invest into those. That's the reason why we have made these investments or making these investments.
Sure. And what would be the order book looking like for Cenexi as such?
I have to come back to you. Give us some time.
Sure. So lastly, on the cartridge capacity, so I mean, one could presume that a lot of that capacity, as things stand today, is the 40 million level, and possibly the incremental 100 million, a lot of that would already be booked to that extent. So in terms of the pricing part, if you could throw some more color, as well as is there some element of take or pay, because obviously your sales would depend on regulatory approvals, depending on market to market. Obviously, you will not be selling based on where the client is selling, but irrespective, maybe some points on the pricing part as well as the take or pay and the regulatory aspect.
So this is more a fill and finish CMO kind of job work. We are speaking to four kinds of customer. Indian players who want to launch their GLP in global market, Indian players who want to launch their GLP in India market, global player who wants to launch their GLP in India market, and global market. Okay. On fill and finish standpoint, I'll give you a range. The range is between $1 to $2. That's the range of fill and finish. And as we are preserving some capacities to give it to the best partner, so that the whole business is sustained. We did the deal with the Indian company for the global market. So this is what the sense is.
Sorry, just one last follow-up.
Hello?
Yes, sir.
Can you hear?
Yes, sir.
What did you not hear, Harsh?
No, sorry, just one follow-up. Lastly, by best partner, you mean a customer who is able to give you good visibility in terms of the volumes and capacity bulk up.
Exactly.
That would be the right term.
Exactly. Customer who has a strong presence in that country of launch, and a customer who are very serious about making this a good product in that country.
But you could say for the next 1 to 2 year period, let's say very broadly put, maybe at the India level or at a global level, there could be certain supply constraints in terms of fill finish with the cartridge capacity, as well as the pen assembly. Maybe these two components could have some level of supply constraint at the India level or let's say the global level.
It depends on how this market plays up, but time will tell how SEMA will, for example, one of the proprietary company has launched SEMA in a while, their GLP in a while in India. Okay. It really depends on how this market plays out. But the volumes are encouraging. And we are getting prepared. We are prepared. At 140 million, as I told you earlier, we will be one of the top tier cartridge capacity company in the country.
And there was a question around order book of Cenexi. It's around 100 million.
Sure, sir. Thank you. All the best.
Thank you. Our next question comes from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, thank you for the opportunity. So firstly, with the two contracts on GLP-1, how much of the 40 million capacity is booked out?
No, that will be, most of it is will be consumed. So that's the reason why we have invested in the second line. Because I think, it will be in a phased manner, in the next few years. So the second line will up and running by end of this year. So this 40 million will not be enough for the new partnerships what we're going to enter.
Got it, sir. So when you spoke about this $1-2 for the CMO fill finish on the pricing front, is there any annual repricing clause?
Yeah, it's always there. All the contracts it will be there, depending on the cost structures and all that. Yeah, it's always be there. And also there will be, especially the CMOs, there are two types, right? One is of course the tech transfer that happens on product, or the pure CMO. So pure CMO always have these clauses based on the volumes. They pick up certain volumes, there will be pricing, and lower volumes, there will be higher pricing. So there's a tier pricing for this.
Understood. The second question, you mentioned about passing on most of the tariffs to your clients. Have you had any conversations with your clients on this front, and what has been the initial feedback?
While there's no real concern from our partners, because if you really see the tariffs is on the transfer price, not on the end price, so the impact will be lesser. And there were a couple of conversations, but it was very clear that it will be passed on.
Got it. And one final clarification. Did you mention double-digit EBITDA margin in Cenexi in FY27 or FY28?
27.
Understood, sir. That's it from my side. Thank you.
Thank you. Ladies and gentlemen, with the interest in time, we will be taking one last question from the line of Mr. Vivek Agarwal from Citigroup. Please go ahead.
Thanks for the opportunity. So my question is on the US business. So this year in FY25, overall growth was almost flat. Is it possible for you to give some color how the existing products have done as far as the volume growth is concerned, as well as the new launches, and how the pricing have behaved?
Yeah. So Vivek, as I told you, if we in the US FY25, the volume growth has been plus 9%. The price has been minus 5%. On the new product front, for the full year, the new launches in the US contributed to 6% to the overall revenue. The new product gross margin is 72% for the full year. So yes, these are data that is around the US.
Understood. And for the next year, right, you are giving a kind of mid-teen kind of growth at the consolidated level. But how to look at growth in the US? Because I think you need to fire in the US in order to achieve that kind of growth, is what is my understanding. Or, for example, it is the other markets you are picking up higher growth. Thank you.
So if you see, Vivek, the US market, our top 10 molecule revenue, grew by 26%. So we are really preserving our top business in many ways. And because growth is a function of new launches, new approvals that will come on an average. We launched 33 products this year, and we intend to continue that momentum in the coming year. So it will be a combination of new customer acquisition, and it will be a combination of new customer acquisition plus value expansion with new ANDAs and all of that with existing customers.
So US, the estimate is next year 18%, 12% on the products and 6% on the CMO projects to the US. It's about 18%.
Understood. That is quite good. And lastly, actually, if you can answer, so going into front end in the US, so is it still there on the platter or the plan have been dropped?
Still evaluating. I mean, like you said, everybody is paused, so we are looking at how this tariff thing works out and how it's going to impact and all that. But it's not out of platter yet. We're still looking at it.
Thank you, sir. All the best.
Yeah.
Thank you. Ladies and gentlemen, we will take that as the last question. I will now hand the conference over to Ms. Runjhun Jain for closing comments.
Thank you everyone for joining us today. We truly appreciate your insightful questions and engagement throughout this session. Should any further questions arise, please don't hesitate to reach out to us, to our investor relation team. We look forward to connecting with you again next quarter. Thank you.
Thank you. On behalf of Gland Pharma Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.